So when you think about convertible securities, you really think about three types. One is a convertible note. Another is a KISS, which stands for Keep It Simple Security. And a third is a SAFE, which stands for Simple Agreement for Future Equity. Now, all of these are more similar than different. In fact, you can customize them so they look pretty much the same. However, if you are to draw a hard line, you draw a hard line between a convertible note and a SAFE. And the difference just centers around when the security converts into ownership of a future company. So with a convertible note, you really have three different times it can convert. One is at the maturity date. Two is upon a qualified financing. And three is upon a change of control. So what makes a convertible note different is that part where it has a maturity date, because in some sense it acts like debt, even though it isn't. So for example, debt is a loan, and with a loan, you have a maturity date and interest. The same thing with a convertible note. Whereas with a SAFE, you really have two opportunities where it converts into equity in a company. And that's around the qualified financing or the change of control. For all of these, generally, the qualified financing is when you raise a equity round, and a change of control is in the unlikely event that the company gets bought before you have to raise any money. Now, the KISS, that can go either way. So you can have that debt element in it where it has a maturity date, or you can make it look more like a SAFE where it doesn't have that maturity date element to it. But again, you can customize them so they all pretty much look the same, with the biggest exception being that whole maturity date interest element that the convertible note has, because again, it looks more like debt, even though it isn't. In reality, it will mature into ownership in the company because most startups don't have money to pay cash, and the interest rate that accrues would typically just be converted into equity in the company. So I've highlighted in blue the categories that I think are the most important. Maturity date and interest rate, they work together, and they're the biggest difference between a convertible note and a SAFE. Because it mimics debt, even though it isn't debt, what it basically means is that it will convert at the maturity date. So if you have an 18-month maturity date, then it says that in 18 months, the security will convert into equity in the later company. And the interest rate is just that, paying interest on it. Qualified financing, that's, again, another conversion trigger, another trigger that when you convert into ownership of the company, typically that's when the qualified financing is when you raise a price round. And so it'll say something like, okay, when the issuer gets the aggregate of $1 million in preferred financing. And then the other two are very important because they really incentivize your early investors. Because again, these are friends and family, you're really early company, you don't have anything. So what the valuation cap does is it say, all right, say your company's worth $10 million. For our valuation cap, for our early investors, it can be worth no more than $5 million. Typically, you see the valuation cap in the $3 to $5 million range. And the discount works similar, except it's with a price per share. So whereas, let's say, for the later investors, it's $1 per share. For your early investors, if they get a 20% discount, it'll be 80 cents per share. Change of control is not highlighted because it's very rare, because basically what that means is if your company gets bought before you raise a later round. And so what you'll typically do is early investors will get their money back plus some sort of premium. Most favored nation is where if you're doing more convertible securities, right? Not a price round, but if you're doing more convertible securities and you offer those later people better terms, you have to go back and give that to the early investors. High resolution is just the opposite. That's saying that, all right, you can treat investors different. So an example with that is, let's say an early investor comes in and puts in $100,000, whereas everyone puts in 10. So it's like, all right, this investor's put in more money. Let's give them more rights than we did everyone else. And then pro rata rights is just another way. Some people call it participation rights, but basically it means that when you raise a later round, it gives your early investors the right to participate in that round to keep their equity percentage. Because as you know, when you raise money, everyone gets diluted. So if originally you had 5% and you were going to get diluted in the later round down to 1%, let's say, it gives you the right to buy in up to that 5%. Great. So I hope that was helpful. I hope that answered a lot of the big questions around convertible notes, KISS, and safes. But if you have any more questions, feel free, shoot me an email, mjames@facinlawgroup.com, or you can call me at 443-332-8484, and I look forward to answering any questions that you may have. Thank you.